Right now, the U.S. is running a current account deficit of 3.8% of its GDP, which is roughly $1 trillion per year, according to the Bureau of Economic Analysis. What does that mean? Simple. America is spending way more than it's earning and needs foreign money to make up the difference. It's like living off a credit card every month. But here's the kicker. Foreign investors, including Japan, are starting to get cold feet. They're tired of buying U.S. Treasury bonds just to keep the American machine alive. Consequence. According to economists, this growing reluctance could cause the dollar to weaken sharply if foreign buyers pull out en masse. There's a version that this might lead to higher borrowing costs in the U.S., when inflationary spikes, and even a confidence crisis in U.S. financial leadership. The $22 billion bond sale nobody wants. Looking ahead to 2025, the U.S. is trying to sell $22 billion in 30-year Treasury bonds. But the last auction, a disaster. Domestic buyers participated at just 14%, down from the 6-month average of 17%, as reported by the Wall Street Journal. Foreign central banks, too, are trimming their U.S. holdings. According to the New York Fed, U.S. securities held for foreign institutions are now at their lowest level since 2017. Why? Rising inflation, political instability, and, let's be honest, just not wanting to hold the bag anymore. Consequence, analysts warn that if this trend accelerates, the U.S. may be forced to rely on the Federal Reserve to buy more debt, aka money printing. That could devalue the dollar, push inflation higher, and undermine global faith in American fiscal discipline. The quiet shift, Dedollarization. We're in the middle of a quiet but powerful trend, de-dollarization. Central banks are slowly moving away from the dollar. They're diversifying into gold, euros, and even the Chinese yuan. In fact, about 85% of central bank managers say sanctions are a major reason for this shift. They don't want to be vulnerable to the U.S. cutting off their access to dollar-based systems. Consequence, experts suggest that if the dollar loses its reserve currency status, even partially, it could reshape global finance. The U.S. would face much higher borrowing costs and reduced global influence. A weak dollar and rising deficits. In 2025, the U.S. dollar has already lost 10 to 11% of its value. That's a big deal for foreign investors. If you're holding assets in dollars and the dollar drops, you're losing money. Meanwhile, the U.S. deficit is set to balloon by another $3 trillion within months. Consequence, there's an opinion that this double hit, rising deficits and a falling dollar, will scare off more foreign investors. It could trigger a debt spiral where higher interest payments lead to even more borrowing, further weakening the currency. Japan, America's ally, now under fire. This brings us to Japan. The U.S. is now demanding that Japan raise its interest rates to strengthen the yen, claiming it's necessary to fix the trade imbalance. Translation: make Japanese exports more expensive so American goods can compete. Sounds fair? Not if you're Japan. Their economy is already on the edge. In the first quarter of 2025, GDP shrank by 0.7%, exports fell 0.6%, and household spending, over half the economy, was flat. Consequence: economists warn that if Japan raises interest rates now, it could choke off what little growth they have left, potentially plunging the country into a deep recession. U.S. tariffs are hitting hard. Let's talk about the tariffs. Trump's administration slapped a 25% tariff on Japanese cars. That's a direct blow to Japan's industrial backbone. Toyota alone lost $1.3 billion in April and May. Mazda was so shaken it delayed its earnings forecast entirely. They literally don't know how bad it'll get. Consequence: according to trade experts, this could reduce Japanese auto exports dramatically and cut manufacturing jobs at home, weakening Japan's economic engine. There's also the possibility that Japan retaliates in kind, escalating the trade conflict. Japan's monster debt and fragile bond market. Now, Japan isn't in great fiscal shape either. Their debt to GDP ratio is 236%, the highest in the developed world, and the Bank of Japan holds 80% of government bonds, keeping interest rates artificially low for years through yield curve control. But that ended in 2024, and rates are climbing fast. In May 2025, 30-year bond yields hit 3.15%, the highest since 1999. The 40-year yield spiked to 3.635%, according to Reuters. Consequence: there is a version that rising yields could collapse the BOJ's balance sheet, triggering a bond market crash. Japan might face its own financial crisis if it's forced to raise rates too fast. U.S. infighting and Japan's frustration. Here's where it gets messy. Washington can't even agree internally on how to deal with Japan. According to Bloomberg, negotiations broke down because U.S. officials couldn't align their strategy. Japan is growing increasingly frustrated. They're saying, "How can we negotiate if your position keeps changing?" Consequence: this lack of cohesion from the U.S. government could damage trust, not just with Japan, but with all allies. Diplomats warn that countries may begin seeking new partners that offer more stability. The CPTPP in Japan's countermove. Instead of waiting to be pushed around, Japan is shifting its trade focus to the CPTPP, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. This is the 12-nation trade group Japan helped lead after the U.S. quit the original TPP in 2017. In early 2025, Japan's exports to CPTPP countries surged, with a 17% increase to the Middle East alone. Deals with the UAE are helping Japan reduce dependence on the U.S. Consequence: analysts believe this move could strengthen regional trade networks and weaken U.S. influence in Asia-Pacific trade policy. The U.S. may find itself increasingly isolated as former allies build new economic ecosystems. The nuclear option: dumping U.S. treasuries. Japan holds $1.1 trillion in U.S. Treasury bonds. That's a massive chunk of America's foreign-held debt. In May 2025, Japan's Finance Minister Katsunobu Kato signaled that those bonds are now on the table. Translation: if you keep pushing us, we might dump them. Consequence: experts warn that even the threat of a major sell-off could spook markets, drive up U.S. interest rates, and collapse bond prices. If Japan follows through, it could trigger global financial panic. Domestic pressures in Japan. With an upper house election coming on July 20th, 2025, Japan's Prime Minister Shigeru Ishiba is under pressure to show strength. He's calling this a battle for national interest. Negotiators like Ryo Akazawa have tried to offer compromises, like opening up Japan's agriculture or LNG imports, but the U.S. isn't biting. Consequence: if Japan sees no progress, there's a version that they might speed up their financial diversification and reduce dependency on the U.S., potentially ending decades of strategic alignment.